Hello, everyone. Thank you so much for joining us for our third quarter webinar. My name is Jeremy Cronemeyer. I'm the Operations Manager for Wickham Financial Group, and I'll be your host today for the webinar. And these webinars we do on a quarterly basis, and we try to focus on five core things that we hold here at Wickham Financial and Insurance Services to go over a total wealth management approach that Graham's going to kind of talk more about here in just a minute. So for today's webinar, we'll be focusing on some things that are front of mind for most Americans right now is geopolitical events, the Federal Reserve, and the elections coming up. So without further ado, Graham, I'm going to turn it over to you.
Hey, thank you, Jeremy. And again, thanks for all of our listeners really jumping on the call. And like Jeremy said, at Wickham, our culture is about wealth management, and we consider 5 steps in terms of addressing wealth management. And that's really addressing all aspects of your wealth through all stages of your life. So let's just briefly kind of go over those again. Not in any certain order, but let's think about investments, right? So what vehicles do we need to put into your portfolios, your accounts, to get your proverbial car down the road, right? What do we need to grow those as? Protect, generate income, stocks, bonds, cash, so on and so forth. Then we want to think about risk management strategies. How do we transfer risk so you're not bearing all of that? Now, risk management strategies are going to be more than just mitigating risk with your investments. Again, it's going to be transferring risk to maybe insuring companies. So it might be like auto insurance. What role, what limits do you need for that? Your home, life, health, long-term care, disability. What role do they play? When should you bring those in a part of your plan? If you owned a business, what about workers' comp, general liability? The list is long. Then we want to think about retirement planning, right? That next stage of life, right? That new chapter for you. So we want to think about retirement planning from the standpoint of cash flow. What do you need? When do you need it? And where are you going to draw it from, right? Then we want to think about estate planning. So think about estate planning as this. How do you pass on, or when do you pass on what's important to you to the ones and things you care about in a timely, efficient manner? Now, in that area, we might be addressing titling of accounts, positioning of accounts. We might be addressing a will and the role that might play. Probate mitigation. We might be thinking about trust. All these things are a part of a proper estate plan. And then we get into, last but not least, tax strategy. How do you keep more of what you worked hard for you, right? Listen, it's your legal obligation to pay less taxes. You got to pay what you owe. Well, just don't pay any more than what you need to, right? So we want to think about tax strategies. Tax now, tax later, never tax. What role, what bucket should be filled at what level? So that gives you maybe an idea of Wickham wealth management approach that we take in those 5 steps. And we try to bring that in as your client. We always talk about it. We're trying to always bring that in as considerations, making sure those boxes are checked. So let's go ahead and jump in to our third quarter call. Now, this one's kind of I would say kind of a special one because I want to spend a little more time addressing what I hear the most in terms of concerns with consumers, what we're hearing in the news. So let's talk about geopolitical events and what effects do they have on your portfolios, the markets. We're going to talk about the election years. What does the past look like? How has that affected the markets? How could that affect your portfolios? The Federal Reserve, what is their role with interest rate policy? What are they doing? What are the effects on the markets, your portfolio? And what is that path for them that they're laying out going forward? And then we'll kind of wrap it up with some general recommendations, maybe a little banter back and forth, going over some questions that we might have just as a team to present to you. But let's go ahead and jump in. Right off the bat, geopolitical events. I know it's nerve-wracking. These events are absolutely horrible, but unfortunately, they're a part of life, and we have to deal with them. In its headline risk, it's volatility in the market, but keep in mind, it's volatility in the market. It rarely affects the markets in the long run. The markets generally take it in stride. And we just threw out some right here where, let's look at the Cuban Missile Crisis. Heck, we saw a total drawdown in the markets of about 6.6%. That bottom was about 8 days. How many days did it take to recover? 18. But let's go up even further and let's hit Pearl Harbor. I think that was pretty major. The drawdown in the markets. Now that was, World War II. So the drawdown was about 19.8%. In the 1 day, it was about 3.8%. It took about 143 days to bottom, about 307 days to recover. So I would say in our list right here, that was by far the most erratic. But again, we keep going through these. Now the average is about from a day drop, about a day drop. The total drawdown in terms of days was about 4.7 days. Days to bottom was about 19 and about 41 days to recover. So we're not talking extended periods of time, at least on average. Now, how has that affected stocks, the market? On average, the market was down about 1.3% 1 month. 3 months later, it was pretty flat. 6 months later, it was up about 2.5% and up about 2% over 12. Now, that's average over those events. If we throw in a recession, right, it was down about 3.8% in the month. 3 months, about 6.7. We're looking at about 11.5 over 12 months. And let's say no recession, because I think that's kind of the area that we're in right now. We don't see a recession. Doesn't mean we're not going to have one, because we are having a slowing economy. We just don't think the odds are that we're going to go into a recession. Certainly not in 24, 25. We'll just have to see about 26. But no recession, not even down 1%, a tenth. We're looking at 3.1% positive over 3 months. And look at that, over 9 months, a positive 9.2%. So again, no recession, geopolitical events, positive over about 12 months later, about 9.2%. Again, this is history. It's no guarantee that today the future is going to move or be the same, but maybe it gives us some clues, some ideas of what could happen. So what's the general trend? Well, look at the black line. Yeah, you got little squiggles in there, right? You got some drops. But at the same time, there's nothing that hasn't recovered. Yeah, it takes a little time. Some of these drops are a little deeper, might last a little bit longer, but that trend is generally up. I'm going to bring out my my little drawer here and see what I can do. But look at that trend. I mean, we're still looking at an upward trend over time, right? Even though we might have periods of drawdowns, right? So we want to keep in mind the long term compared to the short run, right? That green line, now we're talking about the Fed funds rate. That peaked out, what, late 70s? We're talking 80s, and then that's drawn down over time, all right? Let's go ahead and jump into the election year. Another huge one. We all have our own opinions, and rightfully so. That's our right on who we feel should be in the office, who should be the leader to run our country, right? But let's keep in mind, these are our opinions and not necessarily does the market care. I often say that the market just wants to know, it not necessarily cares who's elected, right? And I don't mean that flippantly, because this is important information in important positions that we're trying to hire, right? So let's think about the market effect and what does it mean with your portfolios. So let's look at the returns in history post-election, because it kind of flows right into some really strong seasonal tailwinds. So let's just flick right over here and let's look at the U.S. large cap equity. Now, I generally call let's just say that's the S&P 500. So 6 months before the election, we're seeing a positive return of 2.7%. But look at 6 months after, the market's up even higher, 7.8% on average. If we come over and look at some small cap area, this area right here, we're looking at 10.8% 6 months after, positive 3 months before. There is nowhere on this whole area here that shows any negatives. I know this is horrible scribble I got going on, but I'm just trying to point out there's not any negatives. The market just wants to know, right? And when the market knows, it can manage through it. So sometimes it's our personal opinion that we try to put on the markets and our portfolios, but at the end of the day, at least from history, it hasn't really affected the portfolios in general. So let's dive into this a little bit further. Let's look at, and we've had these on some, a couple of these slides on some previous quarter lunch and learns or our webinars. Now let's talk about the presidential election years through history. So if we're looking at a new president, we're looking at stocks, and I'm up here in this corner right here. We're looking at stocks and we're looking at bonds. You're looking at a positive for stocks at about 9.3%. Bonds had a positive 6.7% return. We're looking at all presidential election years. We're looking at a positive 11 for stocks and 5 for bonds. But if we had an incumbent president, I know we don't, but if we did, it's a positive 13 compared for 4% for bonds. But let's go down below, because this is where I usually get into opinions. How is a Republican president going to affect the markets compared to a Democrat? All in all, it's still positive. But the S&P's performance over election years, it's been slightly positive. You know, for Republicans, about 11.5% compared to 3.3% for Democrats. The average performance in those election years are still 7+%. Now, over here on this right side, we're kind of talking about, you know, how has the market performed under 6 scenarios? Maybe having a Republican president, or maybe a Democrat president. What about a sweep, a divided government? It doesn't matter. Long story short, this market is up. But I think one thing that's really interesting, the odds are we're probably going to be moving in, and this is all since 1933, probably a divided. So let's look at these latter 2 blue right here. We're looking at a positive in the market at about 14 and 13%. Why might the market like that? My assumption would be is that they feel that they can't pass anything that might be a negative, right? It's just gridlock, if you might. So what's the percentage of time that we usually get in a divided government since 1948? That's 64% of the time. That's pretty high. So the odds are we're going to be facing that again this time, and we know what the performance numbers could look like. Excuse me. So let's look at performance numbers again under certain scenarios. Since 1933 to 2023, you know, it doesn't matter. The market's still positive, you know, depending on, you know, who has control, who was elected as president. Still positive numbers from 15.7% all the way to a Democrat Congress and a Republican president, a positive 4.9% for the S&P from 1933 to last year. Let's talk about timing. Let's talk about trying to time this market with elections. Let's go one step further and say, let's say we only want to invest in the market when we had a Democrat president or if we had a Republican president. Now, we went back and looked at 1949 to 2023. How did the S&P performance look like in terms of $100 invested? All right. So let's just say we stayed the course. We wrote out everything. Listen, that $100 over that time period would be worth just over $31,000. Massive performance on a $100 investment. But if we just miss 20 of the best days, think about this. We're going back from 1949 to last year. If we just miss 20 of the best days, and that's not hard to do. The market can have a great day when it opens up down, and you think it's going to be a bad day. That was 8,115. That's quite a bit less than 31,000. Well, let's go if we only invested if we had a Democrat president. You're up 3,765. But if it was Republican, it was $834. Dramatic difference in all of them. Now, I'm not picking on a Republican or Democrat because we got to throw in the .com was pretty bad for the markets, really bad for the market. And that happened to be under a Republican president. So I'm not saying anything negative towards that at all, but that's affecting and skewing that number a lot. So keep in mind, listen, let's stay invested for the long term. Maybe take our opinions and put them on the side. Don't let them affect who's elected, affect our portfolio, our retirement plan, so on and so forth. Let's look at the Federal Reserve. So we covered the first two. The last one I get. What if the Fed's lowering rates compared to raising? How is that going to affect the market? Well, let's look at it this way. If the market I mean, took a dive. What? Down 20+% for the S&P 500 in 2022 when the Fed raised rates, the fastest pace ever in history. When we had inflation about 9%, inflation's headlines about 2.5% right now. Now they're in a stage of lowering. They already dropped 50 basis points in September. So let's see what happens with Fed funds rate. Let's see how it's going to affect the market and kind of what is their path. So if the market went down when they raised rates, what do we think could happen when they start to lower rates? That's what we want to look at here. So let's jump into these slides. So all in all, you can see the story is still positive. It doesn't matter if it's 1 month, 3 months, 6 months, 1 year. If we go back, and it doesn't, again, matter asset class. If we're looking at U.S. aggregate bonds, bonds are debt, generally move into bonds for stability, income. Maybe a little later in life when you're thinking about preservation, a little bit, maybe a lot more than growth. U.S. Stock market, the S&P 500, 1 to 3 year corporate bonds, munis, high yields, 3-month T-bills. It doesn't matter. We put it all in here. It doesn't matter. The market is up. 1 year later, look at this. This one's pretty interesting. The aggregate bond portfolio has beaten the S&P 500 with about a quarter of the risk, and that's the area I'm talking about right here. Up about 10%, where the S&P 500 was up about 9.3%. Now, keep in mind, history is always changing. There's no guarantee it's going to repeat itself just like the past, but I think it's pretty interesting. I think it can relieve clues to what's going to happen going forward. Here, let's go and look at Fed rate policy. Now, obviously they've paused, and now they've started to lower. And how is that going to affect core bonds? How is it going to affect general U.S. stocks? Maybe a portfolio you hear about called a 60-40. 60-40 is going to be 60% stocks. It might be about 40% bonds. If you look at it, it's positive across the board. If we look at 1 year, then 5 years. 1 year is going to be that dark blue line. 5 years is going to be 5 years is going to be that light blue line. So let's look at core bonds. Now they've started to lower. That's exactly where we're at now. We're past the pause. They're starting to lower. They already said they're going to lower. How quick, how fast? That's really the question mark, right? That's the drama in the market right now. But core bonds, it was up 10% 1 year. 5 years later, we're still positive 7. U.S. stocks up 16%. 5 years later, 9, 14 to 8 for a 60-40 portfolio. Moral of the story is it's positive. There's an old saying in the market: don't fight the Fed, right? I'm not going to tell you you're not going to have drama. I'm not going to tell you you're not going to have volatility and you might not get 10 or 20% corrections. But the general trend of the market, at least from the past, and I think it's going to be a clue for the future, a very strong hint, is that it's still up. And I think that's where our mindset needs to be. Now, where is the Fed's path here? This is coming from the Fed, their general path. Now, they have said they are data dependent. So this could change. But generally, we've gone from a Fed funds rate of 5.25 to 5.5. They've already lowered 50 basis points. So by the end of the year, they're projecting somewhere they could be at 5.5 to 4.5 to 4 3/4. By 2025, 3 to 325. Then 2026, 2 to 250. Think about the spans here. We're talking 2 years. And at that point, we're 3 basis points down. That is a dramatic drop in the Fed funds rate. If they've got to drop a lot quicker, a lot faster, they might be worried about growth fears. That could be a concern for the market. You might see equities drop, maybe a good bit more than bonds, because bonds tend to be, at least if history is any guide, bonds would be a safe haven compared to stocks being the equivalent of a risk asset. So last but not least, let's get into general recommendations. All in all, stay the course, right? We all have our opinions, and rightfully so, but let's don't just assume that the market's going to react on that. Let's look at increasing duration. A lot of money, $4 trillion have gone in money market funds. I get it. You get paid great in money market funds. We haven't seen it so long. But by being so focused on that area, that risk-less area, or money markets at a brokerage house might still have risk, even they're ultra conservative, they're money markets. we might be missing opportunity, right? Because if bonds went down because the Fed's raising rates, what do you think is going to happen when they start to lower? The odds are bond principal value is going to go up, even though their yield might go down. The coupon stays the same, but the yield might come down. So you're getting capital appreciation and income. That's a great environment. We haven't seen a long time in bonds. Stocks love it too. Think about it. Interest rates coming down. Usually small caps love that. They have more floating rate debt than large cap stocks. And in that situation, that would make their borrowing costs less. That means more profits and revenues, or at least profits, not necessarily revenues, but more profits that they could use in other areas. It can help large caps, but not as much as the mega caps, because they generally don't have to go to the banks for any loans. Let's create a balanced approach, right? Yeah, it made sense, right? Maybe a bit in hindsight to focus in on tech or that AI space. This market has really broadened out. And we think the time to overweight in certain sectors is probably behind us. Just stay broad in your approach, diversified portfolio, making sure that from a diversification standpoint, you're not leaving some asset classes behind. Think about small caps versus large caps. Now, there's a reason why small caps have underperformed. They're more challenged financially with interest rates, not to mention growth, but they're trading at a 14 times forward earnings. Well, let's just use the S&P trading at 21 times forward earnings. All right. They usually trade much more in line with each other. So we think there's some catch-up room with small caps compared to traditional large. What about international compared to the U.S.? I think the number is still about a third difference in value. Right? So maybe there's a catch-up trade, because I think internationally they started lowering their rates a good bit quicker than the United States. So if we're looking to have positive performance with our Fed lowering rates, they're already lowering rates, maybe there's a catch-up trade there, right? So diversify, create a balanced approach, stay the course, increase duration a bit. I mean, coming out of those money markets a little bit, you can still go into ultra safe assets. We're always here to have those conversations with you on what they might look like. But we think that's probably the direction. Jeremy?
Got it. Well, while you were talking, Graham, I had some kind of thought about some questions here. Yep. So October's generally, how's October generally for the equity markets historically?
Yeah, no, that's a great question. Generally, September and October are two of the worst months in the market, right? September was actually positive. Now, that hasn't been true for the last 5 years, which means, well, October going into an election year, sure, the market's up a lot. Would it be logical that the market could have a down October? The odds are, sure. Will we? I don't know. There's no crystal ball, but the odds are, right? But let's think about this. If we're down because of an election year and people just get nervous, they want to take some profits, and rightfully so. You should. You got to pay yourself sometimes. We're backing right up to, or running right into, the best time of the year. Seasonality is fantastic from November on after the first of the year. So also think of this, the Fed's lowering interest rates, which could be a great backstop for the market. I'm not saying you want to rely on that, but again, all the reasons that I just talked about are very favorable to bonds and stocks. Even if we get volatility, that money coming off the sidelines from those money market accounts, which is a ton, $4 trillion has to find a home here. It might not all go to stocks. It might go to bonds, but it's going somewhere, right?
Right.
When they look at their bank statement, they're not making 5% anymore.
Right. Well, that kind of leads me into my next question: is the some seasonal strengths. What do you think about that?
Yeah, I was just commenting on it. November through the first of the year, that's traditionally one of the best times of the year, right? A lot of window dressing going on, meaning right sizing of portfolios. Money has to get invested by the end of the year. By April, tax time, so it can flow all the way through tax time. Traditionally, one of the best times of the year in the market. So we got the Fed on our side. We got seasonality on our side. Even though we're in the worst months of the year, we got a presidential election. Creates a lot of nervous attitudes, a lot of anxiety, but I wouldn't let that derail you from taking advantage of that seasonality that we're running right into.
Gotcha. And the last one, you mentioned it a little bit there, but the yields have recently have gone, they're pushing down or whatever. What does that do to the bond values?
Yeah, so yields of late have pushed up, right? So think about this, and I talked about it with bonds. So what happened in 22? So inflation was really high. The Fed raises rates to deter borrowing, right? So we don't have those animal spirits accumulating so much, creating inflation. That's good, but not great to a certain point. It's bad, and it got bad, right? So they raise interest rates to deter borrowing, right? So at the same time, what happens? They're lowering rates. And the market was anticipating that, yeah, the Fed's going to lower. Maybe they were thinking that Fed's going to lower too much too quick. Now, 50 basis points is probably a little bit more than I thought they were going to do, but they did it. What they do the rest of the year, that might be the question mark, and the market's going to try to figure that out. That's volatility, right? But what happened? I think the market just priced in a little bit too much, and I think it's got to digest it a little bit. Yields went up, bond prices are coming down, but keep in mind the direction of yields in general are down. You might see the longer end stay stubbornly high to higher when the short end kind of drops a little bit. So we get back into a normal yield curve and out of this inverted yield curve. I know we didn't spend any time going over that. I won't bore you with all that. But I think we're re-inverting. It's good. We're just maybe got a little ahead of ourselves. Again, the general trend is still down. I wouldn't fight the Fed. Just don't fight it.
Got it. Well, Graham, we always appreciate the information and expertise. And thank you to everybody for joining us today for our third quarter webinar. And check us out on social media. Check us out on our website. All of our previous webinars and weekly wrap-ups are all on there on our YouTube channel. And we'll be sending this out via email as well. So if you have any questions or heard anything on this call that you want us to answer, please give us a call here at the office and talk to Graham or anyone on the team, and we can get you set up for a phone call or an in-office visit. But we always appreciate it, and we'll see you next time.
Take care.